Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is the XLF. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today, we're going to chase the rise in interest rates. And how are we going to do that? We're going to use an ETF that tracks the financials, which is the XLF. But before we get too far along, let's pause. Let's take a little peek at what the markets are doing. We currently have the S&P 500 index. Right now, we're just kind of in an area of chop. The S&P 500 index made a strong move going all the way back starting in March. We've retraced back to about the 50% level from that rise up in March. So on the downside, the market's trying to figure out where it wants to go to next. The VIX index isn't really giving us any indication. If I take a quick peek at the VIX watch list, we'll see that the VIX right now is trading right around the 21 level. And I've mentioned this quite a bit here on the Stock Play of the Day, that I'm surprised to see the VIX just hanging out at that level. In my mind, the new low volatility is below the 20% level. And you can sometimes just check that out by looking at the 20-day moving average in the VIX. And we're a little bit above that, but with considering the geopolitical concerns, the concerns about inflation, the concerns about rising interest rates, surprised to see the VIX at this level, even though the market volatility has been tame. There's been a lot of chop in the marketplace. But if we look at the SPX and we also look at the NDX looks a little worse than the SPX. We're having and as far as Fibonacci's are concerned, we've already broken through the 50% retracement level in the NDX and the QQQ, if you want to talk about the ETF. So as far as the charts are concerned, there's nothing really good going on in the marketplace. I'm going to highlight today talking about the TNX, which is the SIBO interest rate index. And I want to look at a chart. We recently had a monthly chart, this is a monthly chart in the TNX. We're going all the way back to 2007. And I want to highlight a few things as to why I'm interested in what's going on in the 10-year and the yield of the 10-year. And I should let you know that the TNX is an interest rate index that tracks the 10-year. I'm going to highlight over here by drawing my cursor that 28.94 means 2.894 is the current yield, and this is a live market. But if on my chart here, I'm going to go all the way back to this high back in 2007, where it took a long time to get back to that trend line, coming all the way back to this is 2014. And you see forever we bounced off that trend line. And when we did, which is now in 2016, as far as the crosshairs on my chart are concerned, we actually did have a fairly strong breakout. And guess what? That set another trend line that came all the way up here in 2018. And then we bounced off of that, came all the way back down to that initial trend line. Now, this is a monthly chart, so you could even draw a trend line right off of this, and you'll see a lot of activity that's following this. And to me, it means a little bit more since it is a monthly chart. Now, this candle is not being drawn at this point in time. But if I scroll down a little bit, I'll highlight that this is current. And the yield has made a fairly strong breakout of that trend line that was set going all the way back to 2007. That high was set all the way back on 2018. And the path of the least resistance would be all the way to the upside, to that dot that helped us draw our trend line there. So the question is, how fast is the marketplace looking to raise interest rates? And the Fed and what they're going to be doing over the next couple of quarters, the next couple of meetings, how quickly are they going to be raising in 50 basis point jumps, or are we going to look at 25 basis point jumps? The market seems very tame trying to figure out exactly where we're going to be going with those interest rates. So the banks have announced, the banks have had a good run as far as 2022 is concerned, and they have sold off a little bit after earnings. Well, we've had a little bit of mixed results, let's put it that way. We're going to look at the XLF today. We had Bank of America announce yesterday, based off of their earnings report. They had a good run with it. We had Charles Schwab also announce recently, and they had a big downturn for Charles Schwab. They were down about 7 or I think it was about 7 points, or about 9% in the market. So we're having a little bit of mixed results on the banks, but as the year ends, as we get to the end of this year, rising interest rates should be good in general for most of the banks. So we're going to stick with the XLF. We've talked about this trade before here on the stock play of the day, going back about 6 months or so ago. The XLF is the preferred ETF to talk about here on the stock play of the day. Obviously, we work for Ally. We are in the financial world, so we just like to stick a little bit with the general market when we're talking about interest rates. And the way that we're going to try to play it is we're going to go long the XLF using option contracts. And this time around, because of the market conditions, we're going to go way out in time. The actual trade that we're going to be looking to do over the life of this option contract, and I'm going to run to the options playbook right now, is going to be the fig leaf. Before, we just talked about a fear of missing out using the XLF. That means that we bought a deep in the money option contract going out about, I think it was about 5 or 6 months in time. You'll have to go back and look at the playlist to figure out exactly where we were. This time, we're going to go all the way out to January. We're going to go out over 270 some days. And because of that, we are going to be selling some call options against that position. Now, the fig leaf inside the options playbook is also known as the leverage covered call. That would be the more technical term. The fig leaf is an alternative to actually doing a covered call position. And the reason why we came up with the term the fig leaf inside the options playbook, if I scroll down a little bit here, we'll see like a little bit of the history about the name. This is the only play that tells you a little bit about the name because we actually coined the name of this strategy. And the reason why we like to call it the fig leaf is because you're kind of covered. In other words, if I am a covered call trader, I own the stock. If the stock gets called away from me, I have 100 shares of stock. I just give up my stock. It's a very simple transaction. On a fig leaf, we're trying to buy a surrogate for the stock. In other words, we're looking to go deeper in the money, buy an option contract with a lot of time, and if we were going to buy 100 shares of stock, guess what? We buy one call option that would be representative or give you this kind of the act as a surrogate, if you will, for the stock, but not have as much risk or as much downside. The main problem of doing a fig leaf is that you still have time value. You're buying a lot of intrinsic value because we're going to go deep into money, but it's still an option contract. It still has an expiration date. It's mainly made up of real value or intrinsic value, but there is some time value. So we're going to sell a shorter term option against it. And this is why I say we're kind of covered. As far as the brokerage firm is concerned, you are covered. You have a right to buy 100 shares of that underlying stock at a lower price than you have the obligation to sell the stock at. So in general, that means that you are covered on that position, but you don't own the stock. So if you are called away, you're going to be forced to do something. Either you got to go out on the marketplace and buy the stock, or you have to exercise your long call option, buy the stock via the option, and then give up the stock via your obligation on the call side. So, hence the name the fig leaf. If we're doing this trade, we do not want to be assigned on our short option contract. And that is why we're going to sacrifice premium by going a little bit further out in time. Okay? So, how do we set this up? And as always here on Stock Play of the Day, nothing's meant to be a recommendation. I like to talk about, well, first of all, you have to have very liquid underlying. So you have a tendency to talk about the same type of stocks because there are literally a handful of stocks that have the type of liquidity to look at buying longer term options. And by liquidity, I mean the ability to be able to sell at a fair price and buy at a fair price without paying a huge bid-ask spread. So when the marketplace is in a different state, we're going to look at buying different options, different time periods, selling different option contracts against the position. We've had a lot of earnings so far in the banks. We're just getting over them. Because of that, I think now is the time that we might consider looking at the financials if you do think that interest rates will continue to increase, and more importantly, that the yield curve will widen between short and long-term option contracts. Overall, that is better for the banks if we have the shorter-term interest rate is at a much lower relative to the long-term interest rate. Okay, so let's look at the trade. Let's go on in. I'm going to pull up the stock play of the day charts, or I'm sorry, chains. Here we go. Getting there. All right. So here's the XLF. Right now we see that we're up 34 cents on the day. That's about 1%. Bottom line is it's a $37 stock. So a 34-cent move is a fairly decent percentage move on the underlying. As I said, we're going to go way out in time. I have two expiration dates that I'm going to be highlighting in the chains. One is the May expiration, and the other one is the January 20th expiration of 2023. That's 276 days out. Very liquid underlying, the XLF is. It trades a lot of volume as far as just shares of stock are concerned. The options do fairly well also. And if we go out 276 days, we're going to be searching for a little bit of delta. I don't mind getting an 80 delta, but I wanted to keep the risk a little bit more contained. 80 delta was a little bit more of an expensive option contract. So today we're going to buy, here's the call options. We're going to buy a 75 delta option contract, and this is going to be the paper trade. We're seeing the bid is 520 by 535. So if you were looking to buy 100 shares of stock, you would take 100 times 37, and that would be $3,746 to buy that 100 shares of stock. If we go and buy this option contract and we pay the ask, which is 535, that means that we would pay $535 plus commission, which is about 14% of the total price to buy 100 shares of the underlying stock. So by buying the option contract, we're going to limit our risk to that. We might try to work this trade a little bit. Maybe we can get it at 530 or so. But when you're trading longer term options, one of the biggest problems is liquidity and being able to trade a little bit in between the bid and ask. To be blunt, if we had tighter markets in the longer term options, this would probably be one of the most popular option strategies because I still get a lot of stock participation. By buying the 75 delta, I'm buying something that if the stock goes up 1, I should receive 75 cents or $75 for every option contract that I buy. So if I bought the shares outright and the stock went up 1, well, guess what? I should receive $100. So I'm getting something that acts a lot like the stock, but I don't have all the risk of the stock. And that's because if I buy an option contract, I have an expiration date, I have some things that I need to deal with, but my risk is limited to the price that I pay for that option contract. All right, so this is an interactive show. We want to try to get as many questions as we possibly can inside the chat box. It's part of the reason why we do it live with Live Market. So if you have any questions, please let me know in the chat box. And I'm just going to chug along with our fig leaf strategy today. So now, inside the Ally Invest option chains, if I want to buy that option contract, it's very simple. I just go over to the check boxes here, and I click that little drop-down arrow, and we see a buy and we see a sell. We're looking to buy that option contract. So that would be our long-term options. Now, on the fig leaf, we're going to be selling an option against it. We're going to go out 31 days. We're trading at about 20% implied volatility. That's not extremely high for the XLF. You think about the market right now, the VIX index, the whole S&P 500 index is trading higher than that as far as implied volatility is concerned. Well, right about that, 21%. So implied volatility isn't that high, so you're not going to get a ton of premium for that option contract. And if I look at this, I might say, well, I wouldn't mind getting the 38.50 or the 38 strike going out 31 days. And that's because I'm bringing a decent amount of premium on a percentage basis relative to the stock price. So if I owned 100 shares of stock, these are the option contracts I would be looking at selling, mainly because I own the stock. And if it gets called away, I'm okay. If we're looking at the fig leaf, I'm going to sacrifice premium and go up a little higher in strike. So in this instance, I'm going to sell the 39 strike call to get a little bit further out of the money. But the good news here is that I'm going to bring in 30 cents if I sell it on the bid. And that's a much bigger representation of the total cost of an option contract when I'm only paying $5 and let's call it 25 cents to get long my surrogate for the stock. All right, so if we look at the 39 strike, the way we would set this up in the Ally Invest option chains is we would just click the drop down arrow and we would put a sell in. And we would do this all as one trade. A lot of times when I'm looking at fig leafs, I like to put the position on and let it run. With the market conditions the way they are and the chop that we have in the marketplace, I don't mind doing this all in one trade, all together, sending it to the trading floor as an actual spread. So if I do this, I want to also highlight that we are buying this option. We're getting a lot of delta, the 75 delta, a lot of stock price representation, but we're still paying time premium. And if you want to highlight the time premium, all you got to do is look at the opposite side, bid and ask for the put option, and that will give you a guesstimate to the time premium. It's not an exact science, but I'm going to be paying about, let's call it $1.75 of time premium on this option contract. So by selling that call option, I'm going to whittle away at it. I'm only going out 30 days. This is a 276-day option contract that we're buying. We're selling approximately a 30-day option, and we're bringing in 30 cents. We're whittling away at this time premium that we have to buy. And when I'm doing a fig leaf, a lot of my goal is to literally just try to take away that time premium. That's the one problem of buying options as a surrogate is, well, two biggest problems. One of the biggest problems is the width between the bid-ask spread, and second is even though you're deeper in the money, you still have some time value. So we want to whittle away a little bit at that. So now we're putting this entire trade on. If we look at the midpoint here, we're at $4.94. I'm going to put this in the right rail, and that's going to be the official paper trade for this week. And here's what we're looking to do. We're going to be putting on a fig leaf in the XLF. We're buying to open one of the January 34 strike call options, selling to open one of the May 20th, 39 strike call options. And we're going to do this for a net debit. We'll click on that little midpoint there. We're going to try to work it right around $4.93. We'll move it up, make the math simple. Let's go $4.95. No guarantee of a midpoint fill ever. XLF is fairly decent markets. Want to work the order and try to fill somewhere near that midpoint if you can. All right. So I'm going to do a shout out for questions now. So we'll run on over and check out that chat box. We may come back and look a little bit at the profit and loss calculator and stuff like that. So if you have any questions, and I see that there's a few in there, I'll try to address them. And then also I want to talk, if we got a little bit of time, we didn't get to do a stock play of the day overtime because of the market holiday. So because of that, I might talk a little bit about what happened with Dollar General last week. This week we're talking about interest rates. Interest rates are a concern, rising interest rates with inflation and everything. So last week we talked about a trade that on an underlying company that was a little bit resilient to pricing concerns and inflation, which was Dollar General. And that was also based off of the chart too. All right, so let's see what we have for questions so far. All right, Clinton, I have an account with Ally. Thank you, Clinton. I called and asked them to help me set up a paper trade account. All right, we don't have a paper trade available at Ally. And I don't know exactly when we would be looking to implement that, but I appreciate you having the account. I just can't answer that question. We don't have a paper trading capabilities through Ally. Okay. Do you see okay, so this is from Nathan. Do you see a strong second half of the year or even after the next rate hike? Okay, so I heard, and I'm quoting somebody, and I don't know exactly who I quote. I heard somebody say, well, the market should go up, but they aren't. And I kind of feel the same way. We still have record low unemployment. We have strong markets. Earnings have not been that bad. There has been a little bit of, there's been some trepidatiousness in some of the comments after their earnings reports, but the economy in general is doing fairly strong. We still have geopolitical concerns. The fact that we have some inflation isn't necessarily a bad thing as long as we keep it in check. If it's all about how fast the Fed is going to react. The markets, as far as the chart is concerned, on the short term, aren't really looking good. And maybe has something to do with the geopolitical concerns. The interest rate, to me, is the most aggressive chart that we have out of the ones that we talked about today to the upside. Looking at, well, kind of surprised me actually, just even since this morning, to see how big of a move we've had in interest rates ever since we broke out a little bit to the upside on that. So I think I would agree with that statement, that as far as the markets are concerned, we have the rise of commodities, the increase in interest rates, some of the inflationary concerns, but we still have a very healthy industry. We're still seeing good earnings. So right now we're on a precipice as to where the market wants to go to next. Obviously, I think we're probably not going to go anywhere until we get a clearer picture about what's going on with Russia and Ukraine. And that conflict gets resolved. If that happens sooner than later, then that's obviously nobody that's on this webinar will have any clue as to if it's going to happen to sooner or later. But that would obviously be a catalyst for the marketplace if we could get a resolution in some way, shape, or form. And then I would feel fairly good about the market going into the end of the year. All right. Does Ally have recorded videos? Yes, of course, Clinton. We record all of these on the Ally YouTube channel. If you have somebody that's interested in the beginning of in the basics of options, I did a 3-part rookie course that's available. There's a playlist available inside youtube.com/Ally, and you can find it there. Also, I can put in the chat box if you want to. Let me run just a little bit here and see if I can grab this. We do have an email list that we set up for people that I'm going to try to toss into the chat box here, if I can get it to come up. And if you sign up on this email list, you will get all the notifications for all the things that we have done. I mention it every once in a while. Also following me on Twitter, my handle's @BrianOverby. I usually tweet about all of these events. But if you click that little list or you share that with your friends, you will be on an email list. We only send out one email a week that highlights all the educational events that we have going on, including the stock play of the day and other events within Ally on the educational basis. All right. So let's go back and look at, I got a few minutes, or I got 1 minute here. One thing I did want to mention, and I'm going to try to highlight it here, is just look at the chart in Dollar General. Last week we had Dollar General, we spoke about it. It had just been right around this area where the market was kind of breaking out. This is a monthly chart of it. Looking for that breakout to happen. We did have that breakout happen, and it was more of a fear of a missing out. We were trading something that a retail company that has less susceptibility to inflationary concerns. And because of that, we got the breakout. And what I would do now, we were targeting the 250 level. We now see the stock at 253.83. And this is a little bit what we do on the stock play of the day overtime. I would look to close out that position. And now if you wanted to get long the stock, feel free to. You could do it using a fig leaf. You could do it just buying a deeper in the money option contract, or look at buying the stock. But that is the way that I would have played this trade. And this was a whole scenario that would happen, in that we were waiting for the breakout. So we did a long call spread with a short duration. We got the breakout. So if you still feel comfortable with Dollar General, now which way could you play it? You could go in and still limit your risk by doing the fear of missing out, the fig leaf type trade. You could also just go out and just buy the stock outright if that was your plan. But this was an interesting scenario where it played out the way that we wanted to. So we didn't do a stock play of the day overtime, so I thought I would take this a little bit of opportunity to talk a little bit about that. You can go back and look at last week's stock play of the day, and you can see what we talked a little bit about Dollar General. All right, so one last question here. Let's check it out. And one of the things that a lot of people will ask is, where do I want to get out on this trade? And when I'm doing longer term option contracts, there's an obvious point where I want to get out. And it's just fairly obvious in option trading world. And I'm going to show the change right now. And if we go down to the 34 strike call option, if I put this position on, a fairly strong move it would take to get down to 34. That is the strike price that we are buying. That would be down, let's see here. Let's call it almost 4 points from where the underlying stock is at. Well, 3.5, I guess, is more accurate. On a percentage basis, a half a point is a fairly big move in a $37 stock. So if the market does come down to that strike, I want to get an alert. I want to know that happened, and I want to look to sell my long call option. And here's the reason why. On the way up, I pick up delta. As the market gets deeper and deeper in the money, it acts more and more like the stock. On the way down, it gives me a small buffer. And the buffer would be the fact that you have an at-the-money option contract. That's where all the time premium likes to sit. So I have a natural out if I'm doing this type of trade as an alternative to buying the stock outright. So on the downside, if it did come down to the 34 level, I would just close out the position. Obviously, the short call should be trading for less than it is right now. It gave you a small pill to land on, a little buffer, close out both sides of the trade and just move on. That would be my outlook on the marketplace. Look to do something different, maybe find a different vehicle, but I want to stick to my goals here. Now, if it does go up and it hits that 39 strike, I'm going to jump over here in the options playbook here for a second. And you also want to learn about rolling covered calls. This is a fig leaf, but we're looking to roll a covered call, and that's under the Managing Positions tab. And I'm running long. I thank you all for hanging for the entire show. Please share this with everyone if you can. And we'll see you this Friday. We will be back, and we will do a stock play of the day. The markets are open. So we'll talk a little bit about this trade, and maybe we'll even look at it 4 or 5 months down the road and see exactly where we're at. So thanks for coming, everyone. Click subscribe, ring the bell, let everybody know. Click on the link in the chat box, and please sign up for our email list. Bye, everyone.